so delighted to have you here with us. How are you?
Great to be here. Who knew what I would say one thing in Miami, then I'm sitting here 4 days later. So it's always great to follow the king, Jamie Dimon. So great. Let's go. So.
Well, anything the king said that you thought was kind of interesting, because he did talk about private credit, which is something that's definitely on your radar.
He sounded much more positive than I thought he would.
Yeah.
He's optimistic. He's down at a leveraged finance conference, so I think he probably needs to be. I think he focused on the right things. You can't predict when we're going to have a downturn, but what might cause it. I'm in the camp that actually the stock market has added such a wealth effect to the economy that it actually could be the stock market selling off that actually slows the economy. So they're all kind of intermixed here. And the stuff we can talk about, what I said down there about private credit, I think it rhymes with previous cycles, but every cycle is different.
So let's go there and talk a little bit about how it rhymes with previous cycles. Where does it rhyme specifically, and what concerns you?
So the whole thing about this cycle is that it's not systemic. We don't have the risk. The banks aren't there, so we don't have to worry about depositors being at risk. The similarities are that the banks are lending to the private equity and private capital firms, right? That's going on. They did the same thing to the mortgage companies in 2004, 5, and 6, leading up to the crisis. What did they do? They provided warehouse lines to New Century or credit home lenders countrywide. So they went out, produced the mortgages. What did Wall Street do? They bought those mortgages, packaged them, and sent them out to CDOs, and everyone bought them.
Great old cycle, right?
Same cycle. The same institutions that are now buying, all this credit. And so as soon as Wall Street sees credit turn a little bit, what they'll do is the credit lines that they're now providing into that sector, they'll tweak it a little bit. They'll pull some back. Then what happens, you get left. The reason these mortgage companies went out of business was because they couldn't sell it anymore and it got stuck on their balance sheet. Chair got pulled. So then the real marks start happening when liquidity starts to dry up, and it exposes the leverage. So whenever liquidity dries up in any asset class, it exposes leverage, and no good asset goes unlevered is basically how it goes. So.
It's been incredible, Danny, to see that stocks haven't been toppled by anything that has happened this year. We have so much geopolitical risk. We have AI concerns, private credit. What is going to be the headwind that actually sends us into a correction or worse?
I think it's unemployment. So earnings have been strong enough, I think, to carry the market. I think we've had a broadening out within the market, which has been healthy into other sectors other than tech, which is great. But I think you're starting to see trends potentially in employment. Now, this memo that came out last week that I'm sure you guys were talking about all week, this Trini memo about what AI could look like in 2028, the apocalypse, so to speak, there's some truth to it. And you have to imagine what can happen. So you get all the benefits of being efficient as a company, and your margins improve, so you get that now. But we saw already from Block and what was said, firing 40% of their staff. OneNote literally took pages, it felt like, out of the memo and said, this is what we think we can do now, be more efficient. So those are white collar jobs, and so that's in the economy.
Well, to be fair, I think we're all trying to figure out, is that a Jack Dorsey figuring out the future of that company, right, in terms of management, and whether or not that is an indicator of what's to come.
And there are a lot of people who say that's not something that it's
right.
Reduction in force that's sort of camouflaged as an AI. Like, this is bloating. We're going to be speaking about this a little later.
He certainly overhired probably post-pandemic, but what he said was irrefutable in terms of why he believes there'll be more efficiency and that he doesn't need humans to do all the jobs that they were doing before.
I want to go back, though, to over-leverage, because I always think about who's exposed ultimately. Like, what happens when the tide rolls out? And I'm just curious how you see potentially a crisis akin to the GFC happening because of private credit.
So I think in terms of it fueling the economy and economic growth, companies being able to access credit is great for employment, right? It's great for companies to, but maybe they otherwise wouldn't have gotten it, or maybe the leverage is too high, or maybe the covenants are too light that allow these companies to keep borrowing, modifying loans. As soon as the money stopped coming in, or slowed down, I should say, on the institutional side, what did we see? We saw private credit get offered on the retail channels. Well, some of these banks and brokers are incented to get it onto those channels. And that's my point. When retail investors get the opportunity all of a sudden to buy something,
right?
Caveat emptor.
Listen, we talk about this a lot.
Yeah, this is what we just talked about with Mike Contopoulos. I mean, the idea that it's a signal of something, that the market becomes more available, or what he said is it becomes more democratized. So in your view, not a good idea for the everyday investor to have access to these products?
If I were a retail investor right now looking to get myself exposure, I would be buying Blackstone, KKR, and Apollo. I'd be buying the parent companies, the large PE firms that have permanent capital, that have a huge fee income stream. That's how I would expose myself. And guess what? I can buy it and sell it in the same day.
You wouldn't be putting private credit.
I wouldn't be
private credit. Funds in your 401k.
If I had a retail broker that called me and offered me that, I don't think he'd be my
Because
retail broker anymore.
buying those names are liquid, as you know. Like we cover, right, these firms, you can sell and buy easily. But come on in, Alex, because I know you're listening.
Yeah, we're talking about retail investors, and I actually wanted to ask you, Danny, one new segment of finance that they're actually foraying into is prediction markets with kind of the excess cash that they have to spend. What do you think that will look like later this year as prediction markets continue to grow?
Well, they're regulated by the CFTC. They've taken extreme amount of market share from the traditional online sports books that we've seen. But it's really interesting because I actually use them as a way to follow the news. Not that you guys don't provide all the news that I need here, but you want to know what's going on in the election in Brazil, and you know that you want to either buy or sell Brazilian equities as a result. Watch those. Watch what's happening there. So you don't have to trade those markets, but you need to watch it. And it's really interesting. One pops up, you're like, I never even thought of that. You know,
I mean, I've seen Goldman Sachs, JP Morgan, a lot of big institutional firms citing prediction markets in their research notes really often now.
Right, and they're partnering in the media. They want to get it out there more. I get it. And listen, it's growing. It's a sector that's evolving. But sorry.
Please.
Finish.
No, it's all about
we talked
regulation.
about during the elections, right? Like, go ahead.
Exactly. No, it's where the regulator lies. It's not at the state level. It's at the federal level.
So that use case, I think, to a lot of people makes a lot of sense. But the question, and this is a real question that is available on some prediction markets, will Jesus return in 2026?
Right.
Yes or no? Doesn't necessarily carry the same weight, I think, with someone like you. That's a sign of something.
Yeah, well, I think there's an entertainment value. But I want to say, let me give an example of something that I just talked about on my show the other day, which is, will the U.S. debt exceed $50 trillion by the end of 2028? Even the CBO, which is nonpartisan, has literally 44 trillion. I'm negative on U.S. debt. That's a whole nother topic we can go into some other time. But if it hits 50 trillion, to your point, I say you trade no on that. Because if it's yes, we have a lot bigger issues. What, did we have another pandemic, another financial crisis? We bailed out private credit in the tune of 3 to 4 trillion. How did we get to 50 trillion? So when I see stuff like that, and it's trading at 50 cents, so it's trading at a 50% chance right now, I watch stuff like that to tell me. And if it starts to move, then I start to dig deeper. What am I missing?
You watch it, but you don't participate in it.
Oh, I participate in it.
Okay, how do you participate?
I trade on Kalshi. I mean, I trade these markets. Will the S&P close below 7,800? I trade yes. It will trade below 70 at the end of the year. Will gold outperform Bitcoin?
Right.
Yes, I believe it will. And it's interesting to see how they trade. Will the Fed cut? CME Fed Fund futures will match up directly what you will see on Kalshi in terms of, but I don't want to set up an account and trade Fed Fund futures, but I can just trade yes or no, the 4% chance that they're going to cut in March, maybe. So it's
how much do you allocate to a platform like that?
Not a ton, but enough that it's entertaining.
Yeah.
So I do my NFL there now, during football season.
So does a lot of
I'm going to do my
people.
Masters there during the golf tournament. So use it all, but yeah.
I want to ask you, you said bail out of private credit. Do you think we get to that point?
Well, I would.
You said it.
Yes. No, if we got to that point. So let me ask you a question.
If we got to it.
If we got to that point. Jamie Dimon just mentioned that things are okay. My issue is that things are okay because the Fed keeps bailing us out. There's a moral hazard, and I believe it's in the back of people's minds that actually believe, if private credit goes, the Fed's going to have no choice but to bail it out, and they're probably right. It will have an impact on everything, impact on the banking system.
Right.
It won't bring it down. So I'm half kidding, but I'm not. So what did the TALF go again? A whole nother segment. But post-financial crisis, the TARP, the TALF, the PPIP, we ran out of acronyms, right? So we're going to come up with another one. It could be a vehicle the government subsidizes a period of time. What did they do during COVID? They bought the HYG. But people forget, pre-COVID, we were already going through an economic downturn, and it's kind of resurrected companies that otherwise shouldn't have been saved.
So if President Trump brings in a new Fed chair who is more comfortable with cutting rates, does this just fuel the problem or make it even bigger?
You hope Warsh will maintain some form of independence.
Do you think he will?
I hope he does.
Okay.
I don't know.
Because if he doesn't...
Yes. Well, then you're starting to see what will creep in. Yields will start to move higher on the longer end, anticipating that whatever they do to move short-term rates will fuel long-term rates potentially higher, and you start to ignore inflation. You cannot ignore right now that inflation has stopped going down.
Yeah.
And it's ticking back up. Is it just for a period of time? We don't know yet. But with oil now moving higher, it seems so it's something really to think about, the Fed's ability to cut rates from here. So.
Danny, Lisa asked Jamie Dimon this question. I thought it was a great one. Are you worried more about inflation or about an economic downturn?
He kind of said both go to that. I'm not that concerned about inflation. I'm worried about the question you just asked. If the Fed starts cutting in the face of inflation, what that would look like. I think the economy's fine, but I think that we got to watch employment really carefully. And I think that's what everyone's spooked by this AI memo that kind of came out. We're already seeing signs of that, of white-collar jobs getting lost. So.
Yeah.
We're speaking with Danny Moses, the founder of Moses Ventures, financial computer, and a host of a new weekly series, The Danny Moses Show on Scripps News. He joins us here in the Bloomberg Businessweek studio. Let's go back to what you were saying about AI and the economic effects of that and what that is on the labor market. And dig into the Citrini report a little bit, because you did mention there are parts of it that rang true and other parts not necessarily. And we'll use the Jack Dorsey block news as sort of a jumping off point. Those are white collar jobs. The message was received and has been received. Is that something you see other companies doing over the next 18 months? Reduction in force of 40% and more.
The same way no one was allowed to say tariffs a year ago on their calls, like don't blame tariffs. They're not going to say it. But why wouldn't you as a company? You're a publicly traded company. You have shareholders. Your job is for margin expansion and to produce earnings. If you see the opportunity to do it, it's not a non-for-profit. You're going to do it. And so there's no question that these tools, if you believe the AI secular trade is real, which obviously it is, it's kind of an impact, and you're pro NVIDIA and you're pro all the stuff, then you have to believe there's an end user case for it, both in the consumer and company-wise. And so if that's the case, by definition, it will be you'll be more efficient. I think my takeaway would be, the U.S. consumer finds a way to make jobs around it. It could be something that helps guide that technology. So there's always going to be movement in that, and we've seen massive changes occur. The .com in 2000, right? We heard there'd be no more Wall Street jobs in 2008. After that, it's over.
Right.
Finds a way to reinvent itself. So I just think it's a think piece to think about. Okay, but there's not a CEO, a competent one, that's not already thinking, how do I be more? That's even. Jamie said it, that they use it. Now, he didn't want to say they're firing people, but...
I mean, everybody's using it, and everyone is telling us that if you're not using it, you're falling behind. And we are planning a Bloomberg, not me, but our team, a Bloomberg Invest event that comes tomorrow, and there's a big AI thing that you and I are both involved in. And it's interesting, I've had some conversations about, people say what you should do right now is talk to a 25-year-old. They get how you can use these tools. And the idea is that there will be a dislocation, whether it's 5 years or 7 years or maybe a little bit longer, between maybe an older workforce who's not going to embrace these tools and then a younger workforce who will. And that will free them up from some kind of tedious tasks, but create new opportunities. Right. Do you not buy that argument at all, that that's ultimately where we end? And it's going to be uncomfortable, perhaps, because education's maybe going to have to shift around a little bit and teach things that people maybe lose, or would learn on entry jobs that they're not going to. So there's a shift.
So you have lawyers, you have accountants, and now you're going to have AI tutors. So there you go. There's a whole new industry that could happen. No, but in all seriousness, no. But there are huge positives to it in terms of making every company more efficient, making U.S. consumers more efficient. So that comes with more productivity for everybody. So maybe there's an offset there. I think, again, back to this memo, we don't spend a lot of time on it. People that are saying yes, yay or nay on it, you got to read it. Because I guarantee it's a long read. I mean, it's a 30-minute.
What is everybody missing?
Just that it's a think piece to get, and it's logic. You can't refute that could happen, and it will happen in pieces. And like I said, yes, Dorsey example maybe is just a one-off or whatever it might be, but I do think you talk to any CEO, they're not going to tell you that necessarily. But you know, so somebody's spending capex for a reason. Somebody's plowing money into these privates for a reason. Somebody believes. You wouldn't be doing that unless you thought there was an economic benefit. Well, it's a zero-sum game to a degree. So you don't just increase productivity and everybody wins. I think there's winners and losers here. So
it was amazing, Danny. Just a couple of weeks ago, we saw entire sectors being sold off in tandem, just being dumped because some AI startup said that it was going to replace jobs. Have you ever seen anything like that in past crises? And if that happens again, how do traders navigate that?
Well, I mean, so that's software companies, SaaS companies that always thought that was the best model ever. Yeah, I saw it. Your bank's going to close down, so go get your money out and line up around the block, right? So what did that take? It was the FDIC to come in and say, no, we're okay, TARP, the banks are going to be fine. So yes, you see that panic happen. You saw stocks, you saw Bear Stearns go, you saw Lehman go. Things actually did happen. That even shocked us to a degree. So yes, you will always have whatever the kind of sector trade of the time is, and you will always get an overreaction and creates opportunity potential to buy.
Well, did you trade on any of that?
Which, on the software stuff?
Yeah.
Nah, I'm too negative. No, I'm kidding. No, I didn't. But there are names. There's always one-offs, and I think I will end with this. we're focused on AI and all these sectors. There's so much going on outside of just the technology trade you guys talk about. And all of a sudden, everybody's energy playbook's out in the last week or so. Like,
Right.
oh, wow, these stocks are cheap if oil were to even stay at 65. These stocks are, and it's 3% of the S&P, 4% of the S&P.
Right.
Could be 7. So I just think there's always opportunity to move around. And there's certain sectors which will not get AI'd away. And so as a Wall Street participant, I think you need to focus
We
on
want to go back to risks, but what do you think? I mean, what do you find most interesting in the marketplace today?
gold and, things that no one was, now everyone's on gold, but things.
And you're still on gold?
Oh, yeah. Still long gold, long the gold miners. I think it's up trade. Yeah.
When do you stop that trade? Yeah.
Listen, it's a $35 trillion asset now. No one talks about the size of it,
Yeah.
but it's really big. But geopolitics just reared its head again. Debasement, inflation, it works in a lot of different ways, and it's really a play that central banks are incompetent to a degree, and they're going to do whatever they need to do. So if you think the way out of this, potentially, I just mentioned, is the end game of this bailing out private credit at some point? I don't know, but gold kind of prices all that in. But to your point, these stocks move, the gold miners are up, 100%, whatever they are. Of course, you have to take some off the table. So
what about spot gold at 5,300?
I like it, but I play it through PHYS, which is a physical.
Okay.
But yes, there's ways to express it. But just I kind of watch the flows, watch what's going on, and you got to be smart with it. So I'm not giving advice here, but
Retail also big participants in metals markets right now.
yeah,
What does
metals,
that
silver
mean?
specifically.
Yeah.
I think every metals market's a little bit different. I think the commodity trade is here to stay. I really do.
Yeah.
And so
We're all
I'm a
pulling
big
out our
believer in
old
that.
jewelry and
Exactly right.
I'm not
exactly. You
joking.
can't even get on 47th Street. There's a line out the door. So
I'm not joking. Having said that, back to risks, whether it's private credit, whether it's geopolitics, what do you see as, especially as we continue to see a president who seems to kind of do what he wants around the globe
Right.
in terms of either taking out leaders, for lack of a better word. So how do you factor in geopolitics? Because I'm kind of shocked at the trade today. I expected something much worse, and it was much worse overseas, but maybe that makes sense.
Alex and I were just talking about that before we came in, and I think a lot of this was priced in. So what did we see at the end of last week? Oil started to move higher, but
Yeah.
not to the mid-70s, but West Texas moved up to, call it 68. Then you had Treasury yields lower, and it was kind of odd. Treasury yields were moving lower in the face of higher inflation prints. You're like, well, is the economy slowing? What's happening? And gold was moving higher, and metals were. So you kind of got some. So today is more of a buy on the news type of event. So what happened today? The microcosm I'm looking at today is U.S. dollar rebounded.
Yeah.
The belief that the U.S. is still the ultimate power, the belief that we haven't, hurt all our relationships, so we can be a trusted partner. We got a little glimpse of what that could be, because war always rallies the dollar. I think it's short-lived. So to the point you're making, I think this is a kind of a false bounce. We forgot all of a sudden about the AI trade. You have this MFS in the UK blowing up, which
Yeah.
would have been front page news on Friday and today,
Right.
if there's other stuff. So that's page 2 right now. But here's another, mortgage lending type. Again, not systemic, but also just a sign that money has been circling around the globe trying to find a place to go, and sometimes it's too easy, it's too free. So I just think in general, and the last thing I'll say is I am very concerned about U.S. debt and debt to GDP. That's my big, I know it doesn't matter, no one cares.
No, but it should.
It matters, because one misstep here,
Yeah.
and yeah.
Well, when does it matter? When does it matter?
Well, again, I'm not going to call a failed auction in the 10-year yield, but when you start to issue more T-bills instead of 10-year notes, right? When you start to do those things, you, by definition, create refinancing and repricing risk down the road. So if inflation does come up and the Fed's hands are tied, all of a sudden these T-bills, which you're issuing instead of 10-year, because you don't want to put pressure on 10-year bonds, just doesn't work. And so all we did from 2008 on was just move the risk to the government balance sheet. But you're not going to outgrow it. You cannot. We are not going to run a surplus in this country. We're going to run a deficit. Is it 1 trillion, 2 trillion, or 3 trillion a year? I don't know. Back to the cow sheet, 50 trillion at the end of 2028. We're under 39 trillion right now. That's almost 12 trillion from here. So that's a big concern, because if our rates start to move higher, there's maybe so much to worry about. Just buy U.S. I guess just buy stocks. Honestly, I don't even know. So yeah.
I got cash under
Yeah,
the
I got
mattress.
cash, exactly.
Because you brought us all together. Got 30 seconds. You want to do the last question? We've got a minute left.
I guess, Danny, Wall Street retail investors have this penchant to buy the dip over and over again. And at what point does that backfire on them? Because it's worked so far over the last few years.
Just got about 30 seconds.
I think it's self-fulfilling. I think that even through the tariff crisis of last year, ongoing tariff crisis of last year, ETF flows remain positive.
Mm-hmm.
So passive has still been positive, but that comes down to one thing: employment. If people start to lose their jobs, they're not putting in monthly into 401k. So
Yeah.
that would be where I see the risk.
Right.